You know those giant companies that suddenly fire workers, raise prices, cut quality, and somehow still make investors richer? There's a good chance private equity is involved. Most people have no idea what private equity actually is. But behind the scenes, private equity firms quietly control hospitals, restaurants, retail brands, real estate, tech companies, even parts of your daily life you never think about. And the craziest part? Many of these firms don't even use their own money. They use debt, massive amounts of debt. Today, we're diving deep into the secretive world of private equity, how it works, why billionaires love it, why employees often fear it, and how this industry became one of the most powerful forces in modern capitalism. By the end of this video, you'll understand why private equity firms can make billions, even when the companies they buy struggle to survive. So first, what exactly is private equity? Private equity means investing in companies that are not publicly traded on the stock market. Instead of buying shares like regular investors, private equity firms buy entire companies, or large controlling portions of them. Think of it like this. Normal investors buy tiny pieces of businesses. Private equity firms buy the whole machine. Their goal is simple: buy companies, increase their value, then sell them later for a profit. Sounds normal, right? But the way they do it changes everything. Because private equity firms don't usually hold companies forever. They buy, restructure, extract value, then exit. And some of the biggest firms in the world became financial empires doing exactly this. Companies like Blackstone, KKR, Apollo Global Management, Carlyle Group. These firms manage hundreds of billions of dollars, sometimes trillions in assets, and they influence entire industries. But here's where it gets interesting. Private equity firms usually don't spend all their own money. They borrow huge amounts. Which brings us to the most important concept in private equity: the leveraged buyout. Imagine you want to buy a company worth $1 billion. Most people assume you need $1 billion. Private equity says, no, let's use debt. So maybe the firm puts in only $100 million, then borrows the other $900 million from banks and lenders. This is called a leveraged buyout, or LBO. The company being purchased often becomes responsible for paying back that debt. That's the key detail many people miss. The company itself carries the burden, not the private equity firm. And if things go well, the returns become massive. Let's simplify it. Imagine a company grows from $1 billion to $1.5 billion. That's a $500 million gain. But if the private equity firm originally invested only $100 million, their return becomes enormous. That's the power of leverage. Debt amplifies profits, but it also amplifies risk, because now the company has huge loan payments. And to handle those payments, private equity firms often start making aggressive changes, cutting costs, reducing staff, selling assets, closing locations, increasing prices. Everything becomes focused on profitability. And this is where private equity gets controversial. Supporters say private equity makes companies more efficient. Critics say private equity squeezes companies for short-term profit. Sometimes both are true. Private equity firms usually make money in multiple ways. First, management fees. Investors give them billions to manage, and the firm charges fees every year, even before profits happen. Second, carried interest. This is the huge one. If the investment performs well, the private equity firm takes a percentage of the profits. And when deals become massive, those profits can become life-changing. Third, financial engineering. This is where things become very complex. Sometimes firms refinance debt, sell company assets, or restructure operations to increase short-term value quickly. For example, a private equity firm might buy a retailer, sell the valuable real estate separately, then lease the buildings back to the retailer. The firm gets cash immediately, but the company now has extra rent expenses. Short-term gains, long-term pressure. This strategy has been used many times across different industries, especially retail. And while some companies recover and grow stronger, others collapse under debt pressure. That's why private equity has such a mixed reputation, because the outcomes can be completely different, depending on the deal. So if private equity is risky, why do wealthy investors love it? Because the returns can be huge. Pension funds, universities, sovereign wealth funds, billionaires, all pour money into private equity. Why? Because traditional investments sometimes grow slowly, but private equity promises higher returns, especially during low interest rate environments. And private equity firms often gain access to opportunities regular investors never see. They negotiate directly with companies, control operations, influence leadership, and shape strategy. This level of control is powerful because instead of hoping a stock price rises, they actively change the business itself. That's why private equity became one of the most influential forces in global finance. And over time, the industry expanded far beyond just buying companies. Today, private equity firms invest in real estate, healthcare, sports teams, technology, infrastructure, energy, media, logistics. Some firms even own parts of industries people depend on daily, which creates a massive debate. Should financial firms control essential services, especially when profit becomes the main objective? This is where the conversation gets intense. Critics argue private equity can damage businesses long term. Why? Because debt changes everything. Imagine a healthy company suddenly forced to make huge debt payments every month. Management starts cutting aggressively. Employees feel pressure. Innovation slows. Customer experience can decline. And if the economy weakens, the company may collapse. Some famous bankruptcies have been linked to highly leveraged private equity deals. Critics also argue that private equity sometimes prioritizes extraction over sustainability, meaning take cash out fast, even if the company struggles later. But supporters push back hard against this criticism. They argue many companies were already failing before private equity arrived. And they say private equity often saves businesses by restructuring them. Sometimes that's true. Some companies become stronger, more efficient, and more competitive after buyouts. Others don't survive. The reality is complicated. Private equity is neither pure evil nor pure genius. It's a powerful financial tool. And like any powerful tool, the outcome depends on how it's used. Over the last few decades, private equity exploded in size. Why? Because global finance changed. Interest rates stayed low for years. Debt became cheap, and investors desperately searched for higher returns. That environment was perfect for leveraged buyouts. Private equity firms grew larger, deals became bigger, and entire industries became targets. At one point, some private equity firms had more money available than certain banks. That's how massive the industry became. And today, private equity influences markets globally, not just in America. Europe, Asia, the Middle East, private equity expanded almost everywhere. Even startups eventually interact with private equity through growth funding or acquisitions. The industry became deeply connected to modern capitalism itself, which is why understanding it matters. Because even if you never invest in private equity may still affect your job, your healthcare, your rent, your shopping experience, or the companies around you. So, what happens next? The future of private equity may become even bigger. Artificial intelligence, healthcare, energy transition, infrastructure, these sectors are attracting enormous investment. But the industry also faces growing pressure. Higher interest rates make borrowing more expensive, And since private equity depends heavily on debt, that changes the game. Deals become harder, risk increases, and some firms may struggle. Governments are also paying closer attention, especially regarding healthcare ownership, housing markets, worker protections, market concentration. Some people believe private equity became too powerful. Others believe it remains one of the most effective ways to build and improve companies. The debate is far from over. But one thing is certain: private equity is no longer hidden. Its influence is everywhere. And the next generation of billionaires will likely continue using these strategies to build even larger financial empires. So, private equity isn't just about money. It's about control. Control over companies, industries, jobs, and sometimes entire sectors of the economy. For supporters, it's a machine for efficiency and growth. For critics, it's a machine built on debt and extraction. But whether you love it or hate it, understanding private equity helps you understand how modern capitalism really works. Because behind many billion-dollar deals, behind corporate restructurings, behind major financial headlines, there's often a private equity firm quietly pulling the strings. And now, you know how the game works. If you enjoyed this video, subscribe for more deep dives into money, finance, wealth, and the hidden systems shaping the world. And comment below, do you think private equity helps companies or destroys them?